In this video, we'll explore the question of whether a secured loan can really boost your credit score and what factors come into play. Many people struggle with low credit scores and are looking for effective ways to improve them. Secured loans are often suggested as a solution, but do they really work? It's a question that's been asked by many, and today we're going to dive into the details. Having a good credit score is essential in today's financial landscape, as it can open up new opportunities for loans, credit cards, and even employment. But what happens when your credit score is less than ideal? You're not alone, and there are ways to improve it. One potential solution that's often tossed around is taking out a secured loan. But before we dive into that, let's talk about the struggles of having bad credit. It's not just about being able to get a loan or credit card. It's about the interest rates you'll qualify for, the apartments you'll be able to rent, and even the jobs you'll be able to get. Having bad credit can be a real hindrance, and it's a problem that many people face. So is a secured loan the answer to all our credit score prayers? We'll discuss how secured loans function, the relationship between loans and credit scores, and the potential benefits and risks associated with them. To really understand how a secured loan can impact your credit score, we need to look at how it works. A secured loan is a type of loan that's backed by collateral. This could be a house, a car, or even a piece of jewelry. Because the lender has something to fall back on if you default on the loan, they're more likely to approve you even if you have bad credit. This is because secured loans are less risky for lenders, as they have a way to recoup their losses if you can't pay. But what does this mean for your credit score? Does taking out a secured loan guarantee an increase in your credit score? Not necessarily. The reality is that taking out a secured loan can have both positive and negative effects on your credit score, depending on how you manage it. On one hand, making regular payments on a secured loan can help improve your payment history, which is a major factor in determining your credit score. On the other hand, taking out a large loan can increase your debt-to-income ratio, which can negatively impact your credit score. So it's not as simple as just taking out a secured loan and expecting your credit score to magically improve. There's more to it than that. The key insight here is understanding how a secured loan can impact your credit utilization and payment history, which are crucial for improving your score. When you take out a secured loan, you're essentially adding another debt to your plate. This can be problematic if you're already struggling with debt, as it can increase your debt-to-income ratio and make it harder to make payments. However, if you're able to manage your debt effectively and make regular payments, a secured loan can actually help improve your credit utilization. This is because having a mix of different credit types, such as credit cards, loans, and a mortgage, can actually help improve your credit score. Another important factor to consider is payment history, which accounts for a huge chunk of your credit score. By making regular payments on a secured loan, you can demonstrate to lenders that you're a responsible borrower, which can help improve your credit score over time. To really reap the benefits of a secured loan, you need to be able to manage your debt effectively and make regular payments. If you're not careful, taking out a secured loan can actually do more harm than good. To wrap up, we examined the role of secured loans in boosting credit scores and what you should consider before taking one out. It's not a magic solution, but rather a tool that can be used to improve your credit score if managed effectively.